Welcome back to 5minSmart, your daily pulse on the global economy. I'm Liam.
And I'm Alice. Today is Friday, April 10th, 2026. If you've been watching the news this morning, you know the atmosphere is tense.
Tense is an understatement. The March CPI numbers just dropped, and it feels like the soft landing dream we've been hearing about is hitting a major patch of turbulence.
We're diving into why inflation is making a defiant comeback and what it means for your wallet as we head into the second half of 2026.
So Alice, let's look at the numbers. Headlines are screaming about a second wave. What exactly happened in the last 30 days?
Well, Liam, the consumer price index rose more than expected, but the real story is where that heat is coming from. Energy prices have surged nearly 8% in a single month.
And we know why. The ongoing volatility in the Strait of Hormuz has sent crude oil back into the triple digits. It's a supply shock that's filtering into everything from gas pumps to grocery deliveries.
Exactly. And while core CPI, which excludes food and energy, held relatively steady, the headline inflation is what people actually feel. It's eroding real wages faster than the economy can grow.
That brings us to yesterday's bombshell. The Bureau of Economic Analysis revised Q4 GDP growth down to just 0.7%.
That is the danger zone. When you combine slowing growth, that's 0.7%, with re-accelerating inflation, you get the S word that every economist fears.
Stagflation. It's the ghost of the 1970s.
It really is. The Federal Reserve is now stuck. Usually, if the economy slows down, they cut interest rates to help. But they can't cut rates if inflation is spiking.
So they're trapped. If they hike to fight inflation, they crush the already weak growth. If they cut to save growth, they let inflation run wild. Federal Reserve Vice Chair Philip Jefferson spoke earlier this week about patience. But how much patience can the market really have?
Not much. Market expectations for a rate cut have shifted again. We were hoping for June, then July. Now analysts are looking as far out as November or even early 2027.
It's a higher-for-longer reality that is finally sinking in. The 0% era feels like ancient history now. This is heavy stuff. Alice, I'm meeting some colleagues for lunch, and I need a way to summarize this dilemma without sounding like I'm just complaining about gas prices. Give me today's smart-sounding sentence.
Here you go. The disinflationary trend is currently colliding with an energy-driven supply shock, turning the Fed's patience into a precarious balancing act.
Ooh, a precarious balancing act. I love that. It perfectly captures the Fed's dilemma between growth and prices.
Just remember, Liam, in a stagflationary environment, cash management and inflation-protected assets become the name of the game.
Wisdom as always, Alice. Well, that's all for today's deep dive. We'll be watching the Fed's reaction over the weekend very closely. If you want to stay smart and stay ahead of these shifts, make sure to hit that subscribe button and ring the bell. We are completely community funded, so if you'd like to support our independent research, please check out the Ko-fi link in the description. Your support helps us keep the numbers transparent and the analysis sharp. Stay smart, and we'll see you tomorrow.